And we're live. Well, hello. Welcome to Spark 2020. It's great to be back here again. I'm Guy Brown, for the first time coming to you digitally and from around the world. Despite the fact that Spark has gone global, we're still here in the middle of Sydney, coming live from Circular Quay. And I'm streaming to you from the Hub in Customs House. Thank you to the Hub for hosting us. It's very nice to be able to do it in this wonderful professional space. It's a wonderful professional co-working environment and one of the nicest, I'd say, in Australia and Sydney. So while we stand here in this historic centre of Sydney, I'd like to acknowledge the Gadigal of the Eora Nation, the traditional owners of these lands. We thank you for sharing and carrying the lands that we work, learn and play on. We pay our respects to elders and we share our friendship and kindness. Awesome. So financial modelling and building a financial model that's going to help you win investment. I'm looking forward to this and I'm really excited to be getting it. But let's get some admin-y stuff done. We've got a poll which we're going to put up, so you can fill that up as we go. This is on the Slido app. So we'd just like interested to know who you are, if you're interested in business modelling and analysis and the sort of support that you're looking for, because it's an area that we're really interested in. So questions 2, hopefully we'll have a little bit of time at the end to run through some questions. And this is all done via the Slido app. There's the number. And hey, if you've missed out on getting your questions through on this occasion, then please just get in touch with us at info@purdeyinvest.com. Cool. All right, I'll leave that up in case anyone needs it as I start to dive into this. So I am really excited here to talk to you about financial models. And I can see everyone going, oh, this guy's a bit strange, isn't he? He gets excited about financial models. Well, the reason that I'm excited to talk to you about that is because it's all about getting capital into your business. And if you can get capital into your business, that's going to help it grow. And the other thing to think about when it comes to financial models and understanding financial metrics and monitoring your business, simulating it and measuring the performance, is that this is really, really important for not only you, your investors understanding your business, but actually you understanding your business. And it's going to help you focus down on what is working in your business, what's not working in your business. And at the end of the day, investors are actually investing in venture. They're investing in you. So if they're investing in you, you want to be able to actually show that you can really understand those metrics. So I think it's really important. It's often rather overlooked. I think in a founder's schedule of time, they don't actually give enough attention to really monitoring those metrics. But don't just take my word for that. I clearly am biased because this is something I think is really important. There are other people that also have this opinion. Fingerprint for Success, fascinating organisation. They have monitored founders over 2 decades, and they looked at the skills and traits and motivations of founders that exited between, I think, $6 million and $1.2 billion within 5 years. And they looked at the motivations and commercial awareness, which is everything that we're talking about today, understanding the money, understanding your numbers, understanding your business metrics. They're 43% higher than the average Australian. So I guess the question to you is, if you don't think you're above average right now, then start training, start learning, and the fact you're here is excellent. So Fingerprint for Success, fascinating group. Check them out. If you would like an introduction to a coach or etc., I can provide that. Contact me, info@purdeyinvest.com. So even investors, even if they haven't understood the Fingerprint for Success, they have an innate intuition about whether you're going to be responsible with their capital and whether you're going to be good at those numbers and metrics. So I think it's really important to do that, and let's dive into it. So I said that it's going to be a little bit of a special thing to be talking about financial models, but the good news is today we're going to wind it all right back. We're going to right back to basics, and we're going to get into it with a spreadsheet-free session. No spreadsheets here today, and we're going to do a tiny bit of a counting, but really not much at all. So coming to you live and spreadsheet free today. So what is the purpose of your financial model? The first thing to say about a financial model is it is not about spreadsheets. It is not about accounting. It is about communication. You are communicating the performance and the simulation of your business, firstly to yourself as a founder and a business owner and the management team, and secondly to those investors. So communication is a communication tool. So the better that you can make it, the clearer you can make it, the simpler you can make it, that's actually going to turn out to be a better financial model. Right, so let's have a bit of fun. If you were to communicate one thing that you thought investors would really, really want to hear, what would be the thing that would get their checkbook vibrating in their pocket so much that it's sort of jumping out? What would it, I was talking to one angel investor, he said, this is what makes me horny and this is what turns me off. So what makes them horny? So what do you think that they would just love to see? And we'll have a bit of fun here. Normally I'd have an audience and I could get some people shouting out. We're not going to have time to do on the Q&A, so just yell it at the screen and I'll just, pick it up through the ether. All right, so I can hear lots of yelling against computer screens. Here we go. I think profit. Did somebody say profit? Interesting. Now, profit. I was chatting to a fund manager. He manages, just before this presentation about this and about financial modeling, he manages $20 billion private equity and he has a $200 million venture fund. Yeah, reasonable amount of capital coming into the venture space, I'd say, and following on, etc. And what did he say to me? He said, I don't care about profit. In fact, I've misquoted him. I think he said, I don't give a something about profit. So, big news tip, it's not going to be profit. Next one, come on, another one from the audience. A cash flow break even, what do you reckon? Cash flow break even, right, there are some massively successful startups that are not even yet cash flow break even. And a venture fund manager or an investor is pretty much going to expect that you're going to be coming back for more capital throughout the course of the growth of your business. So actually, cash flow break even is not going to be the silver bullet. And I hear someone say, okay, well, let's wind it back. Next one, I hear someone say, it's all about revenue. Revenue, interesting. Let me tell you about a little company called social media company. I'm not much into social media, but anyway, everyone's heard of this company. It's called Facebook, right? Facebook, in 2008, when they had somewhere between 3.8 and $5 billion valuation, they said, this is what Zuckerberg said, he said, I don't think social networks will be monetized the same way that search did. In 3 years from now, we'll have to figure out how our model is, but that's not our primary focus. In 3 years, he's going to worry about whether he's going to make any revenue. So it may not be revenue either. So I've been a little bit obtuse here. I'm being a bit cute because I want to make a point. Profit, cash flow break even, revenue, these don't in themselves define what is a good investment, and they may not define what is actually creating value for your business. And so you don't want to be suddenly go into creating a financial model, trying to create profit, trying to find this cash flow break-even point, or trying to generate revenues if they're actually not critical to what you're trying to communicate. So what are we trying to communicate to an investor? There are 3 things that you need to communicate in your financial model. 1, how your business creates value. We're going to go into that. That's the big one. Basically, we want to know how an investor putting money into your business is going to go through your business and create value. 2, how long is it going to be until you run out of money? Because they want to know when you're going to be back with a begging bowl for more capital, and when you come back for more capital, they want to know that you've actually been able to get through some of the milestones that are really important. Right, and finally, you need to demonstrate You need to communicate through your financial model that you are going to be responsible with their capital. And the financial model is a really good way to actually demonstrate that and show that to people. All right, let's dive in to the first one, which is the main one and is important. Your business is like the proverbial sausage machine, okay? So what you do is you stuff ingredients in that funnel at one end and the sausages come out the other. I'm pretty impressed with this sausage machine. This is the FCA 80 coming straight to you from Germany. Very fine looking sausage machine it is indeed too. Now, I thought when I said I was put this example up, I made this analogy and I thought maybe I'm being a bit harsh with a sausage machine, so I looked up what a sausage machine, what the definition of the sausage machine is, and it said a system that processes people as if they're bland and lacking individuality. System processes items or people bland and lacking individuality. Now, that's no way to treat your staff. It's no way to run maybe university education. It's no way to do a whole bunch of things in our society, but it is exactly what you need to show in your financial model, and it is exactly what you need to kind of pull out of your business and demonstrate. So, as he's going on a bit of a train here. So, what we need to do is we need to get something bland and lacking individuality, which I cannot think of anything more bland and lacking individuality than money, right? So we need to stuff money down the front of this business, and we need to produce something that is quantifiable, measurable, and to some extent lacking individuality in terms of value out the other end. And that, in summary, is what your financial model is going to do. Pictured here is the sausage machine. All right, so now we need to dive in to this ethereal concept of value. So what is the value? I talked about revenue and profit and cash flow break-even. Now, they're interesting items. They may or may not be what is valuable in your business. You need to work out what is actually the value that your business creates. Now, are you going on about this? Let's give some hard examples. Now, a lot of us would like revenue is easy because it's money and it's something that we all understand and do. But there are a whole lot of other things that are valuable and may not be monetized today, but will be in the future. So when we talk about the Facebook example, they weren't making revenues at that point, but they were creating monthly active users. And they had found investors that saw that in the future, monthly active users were going to be valuable to the business and they're going to be able to be monetized. So if you've heard of the concept of a North Star, the value that your business creates and your North Star should really be aligned, right? And they've got to be something that you can measure and that you can go through and really actually track and see whether your business is actually performing to deliver that value that you are trying to create. So it might be coffee transaction sales. It might be hours in the app. It might be new unique T cells that can help fight cancer. I'm not sure, but it may at this point not be monetary. Now, if you think that your business is already fully monetizing the value that you create, it's probably going to be gross profit. And we'll talk a bit more about that in a sec. But failing all else, and you're really not sure, crunch out your gross profit and see if that is creating value. Right. Cool. So we've worked out what the value is. It may not be monetary yet. The next stage to do, if you've worked out what the value your business creates, is to create an algorithm that expresses what your business is doing. It's the sausage machine, right? And you think, oh, okay, this could be a little bit complicated, but it doesn't need to be. And again, if you can do something and communicate it really clearly and simply, that is actually going to be better. So let me give you an example. Let us build up a little scenario and we'll go through it. And I'll just quickly go back through here. I'm going to give you a little quote from Spring Capital, Michael Chen, who is the general partner there. this is what he's saying. I asked him what he must have and what he'd like to do. And now he's been quite specific. He said he wants customers or revenue growth of at least 2 or 3 times. But I think the key point is here, he wants customers or revenue growth. It doesn't have to be at this point revenue, as long as he can see that there is going to be value and it's monetized. And he also says that he wants the business history and forecasts out. So he actually wants to see you show that he's done it. Right, let us build up an algorithm on how you might actually describe how you can put money in one end and create value out the other. So let us start by looking at your customer acquisition. All right, so customer acquisition is the first point you start with most businesses, sales. So let's imagine that it costs us $20 in customer acquisition to be able to create a sale. So we put $20 in to our marketing and we get $20 at CAC, we get one customer. And then we calculate the lifetime value of that customer. Now, if you haven't actually seen the full lifetime of a customer yet, you can estimate what that is based on the churn of your customers on average. So you know that in this case, we're going to say the lifetime value of our customer is $100 over the course of that. That's on average. And at a 70% gross margin, this is a nice healthy SaaS margin business, we get $70 of gross profit. Great, that's a really simple algorithm and it's a really interesting one because let's look at how it works. You take this to an investor, you show them your sausage machine that looks like this. You say, right, let's put in $1 of customer acquisition, and what comes out the other end is $3.50 of gross profit. Now that's a really, really interesting business. And suddenly investors go, okay, I'm interested in that. And then they'll want to start to dive in and stress test, whether you can keep delivering that. So that is a simple algorithm. Now, if you want to work on your algorithm, I strongly suggest you don't start in a spreadsheet. I suggest that you get your team together, you get the key people together, and you do some whiteboard sessions and you start to build out some flow charts. And usually you're going to start and say, how do we win a customer? Now, maybe if you're a deep tech company and you're not actually getting customers, yes, it's maybe how do you find whatever it is there, whether it's quantum superposition, what are the processes that we do to capture one of those? But most of us, it's going to be sales, sales, and sales, because they're the three things that most startups need, is right, sales, sales, and sales. So how do we win a customer? And you map that process out, all the inputs in, and that's going to help get you to build an algorithm. So I'm now going to dive in to some basic points and tips on how you should go about actually building out your financial model. These are just do's and don'ts when you're building a financial model. Right, assumptions. They need to be clear, they need to be adjustable, and the reason they need to be clear and adjustable is so that you can create scenarios. So do not do this. Do not go and put all of your assumptions embedded throughout your spreadsheet. Pull them out somewhere else, put them in one area, and then reference them back. Now, anything that is hard-coded in your sheet is technically an assumption. So basically, don't bury hard-coded items through the spreadsheet. This practice is so prevalent that I've actually written myself a little piece of software that goes through a spreadsheet and I can highlight a whole area and then goes and pulls out and shows me all of the hard-coded items. It's really common and it's really frustrating if you're an investor trying to actually understand what the assumptions that you've used and vary them and stress test them. So if you don't believe me, this is what Sydney Angels have to say. Richard Dale, who was one of the founders of Sydney Angels, they're one of the premier angel investment groups going for over a decade, and he sits on the investment committee of the Sidecar Fund. He says it must be based on drivers, so sensitivities to key assumptions, and all of those assumptions that he's interested in there can be easily tested. So split out your assumptions, create scenarios. Now, on the topic of scenarios, you want to do a high case, you want to do a low case, and I strongly recommend you do an emergency case for when something like COVID hits and you're not going to have your sales go to zero. And sure, you might get some subsidies here and there, but this is going to be fundamentally different to any scenario that you're pitching on an investment, and you want to have a plan that's in place already. So again, you can demonstrate to your investor that we're thinking about that now. Okay, next, do's and don'ts. Your pitch deck must match your financial model, right? So take that algorithm that you've designed, maybe the flow chart that you used to set it up in the first place, and use that in your pitch deck. If you're not describing in your pitch deck what you're presenting in your financial model, then it's really you're starting to undermine that credibility. And remember, investors, particularly in venture, are investing in you. So make it match. It's really simple, and do it. Now, next one. Split out your gross and operating costs, right? Get clear with the sausage machine about what are ingredients that get stuffed down the funnel and what are materials that are going into building the machine. Now, it's really easy with the sausage machine. This is a piece of stainless steel. This is a switchboard. This is a screen. This is a control unit. And these are sort of meat and spices that are going in at the other end. It's more difficult in your business, but go through and think about it, and think about it critically, and make sure that you are actually capturing all the costs that are associated with actually producing the product or the value that you're creating out of your business. Right. While we're on that topic, if you are taking revenue up front and delivering the service over a period of time, you should really be accruing when you start to look at your gross position. All right, so if you sell a service on day one, you get the cash at day one, and then you have a subscription for, say, 12 months, then you should be not taking 12 months up on that 1 month. You should be taking 1/12 of it over the course of the time. And the same with your costs. If you've got big chunky costs that are coming in, you buy a software license for 12 months that you use to deliver that product, then you should also be spreading that out as well too. While I'm on that topic, there's a bunch of startups out there that have very sizable and fantastic grants from the likes of AWS, Microsoft, Google, etc., to help them going. And these are fantastic, and they're great for getting businesses going. But do not just leave them out of your accounts and your calculations, because you're going to look very silly in 12 months' time when the $100,000 worth of credits on your AWS account runs out, and suddenly your gross margin goes from being 75% that everyone thought was great to being 10%. So start capturing those now, put them through as a cost, put the credit through as an income below your operating lines. Yeah. Right, the next one. Do you know how many models I've seen where people have presented, they've ticked everything that we've talked about already, right? Matches the pitch deck. Nice, good equation, good, sensible assumptions, high case, low case, boom. And then I said, cool, can I see your accounts already? And whoa, right, that's what you've done already? And are you telling me that in the next 3 months, after taking our capital in January, when everyone's in holidays, suddenly you're going to basically triple your sales overnight? Right, make sure your actual results align with your forecast. And this is done all the time. It seems really simple to me, but get your actual results and make sure that they're sensible from there. So, and do the same with costs. I've seen costs like this is great, and you say, let's see what you did before, and it's like that, and they say, oh, but we're not going to spend as much as that this year. Well, investors don't believe it. They'd actually much rather that you were there and you were conservative, and that you showed that actually this is how we're creating value, but these are the costs that we actually need to do that. Right, and if you don't believe me, here's Eric Vertipool. He's a successful entrepreneur. He has exited his business. He's become a serial angel investor. He now sits on the board of a whole bunch of companies. He mentors people. He runs accelerator programs. And this is what he says. It must be a model with a spreadsheet this is a turn-off for him, is that where the model is not a spreadsheet with no resemblance to the reality of their current financials. Right. This is what KTM Ventures, Martin at KTM Ventures says, traction, growth of burn, and I've highlighted burn there because it's bringing us into the next point, which is how long until you run out of money. This is really important. They want to know how long you've got until you run out of money, because you need to deliver that step up in value. What last thing an investor wants is to be getting a down round and having to put in cash at a lower valuation. They want to see that continual step up. And it's also not what you want. So get serious about your cash flow. I strongly suggest you do 3-way accounts. It is probably better to do a 4-line balance sheet and a 3-line cash flow that balances in 3-way accounts than to not do it at all. And there's a reason why the 3-way accounts work, and you check that they balance, is it's a check to make sure you're capturing your costs and to make sure that your cash is not going somewhere that you didn't think it is. The other thing, if you start doing this, is to think about your working capital. Now, if you have a business that is selling something and you may not get paid up front, or you have to buy products 3 or 4 months in advance, you might be making fabulous profits. You might be creating lots of value, but if you've got a 4-month lead time on buying stock, you're going to be using a lot of working capital if you hit the growth rates that you're already wanting to do. And the more capital you need, the more of your business you're going to have to sell, the more investor money that's going to go in, and more dilution. So start thinking about that. And I would strongly suggest you start to create a cap table to do that too. Think about how much of your business you want to own in 5 years' time, and how much capital is going to be to grow it there. And there's heaps of successful businesses out there that have actually grown to be very successful, but the founders have been diluted out so much that it's almost not worth their while anymore. Right. So this is Scalari Partners. This is James Walker, the executive founder there. He says it must have cash burn and time to cash depreciation. And he said it's really nice to have a cap table which is fully diluted. All right, and now this brings us through to our final point, and this one's a bit more ethereal, but you have to demonstrate that you're going to be responsible with your capital, right? And you do that by using skill, care, and diligence in the way you build your model. So let's have a go. Flick back to Eric again. He says this is the first thing he says about a financial model. It wants to give me the sense that they will respect theirs, mine, and other investors' money. Now, I often ask founders when they're looking for capital, I say, great, are you ready to manage and be responsible for my children's education fund? And if that burden of responsibility freaks you out, then you're not ready to take on the capital. I mean, if it freaks you out a bit, then maybe it's getting to you and you're feeling that you're going to be responsible for it, and that's good. But we want that sense of responsibility. It's your capital, it's our capital. It should be looked after, respected, and managed. And as we've seen, as Fingerprint for Success show, the people that do that turn out to be the most successful entrepreneurs. Right, I'm going to leave you with the action plan. So this is your action plan for creating your financial model. 1, work out what your North Star is and what the value that your business creates. It may not be monetary yet, I should say. It may not be monetary yet. But if it is fully monetized at this point, you should be looking at your gross profit. 2, build an algorithm that works out how you can grow that business, how your business works, and how putting money in the front end of that funnel produces value out the other end. And where possible, please keep it simple. 2, align it with your pitch deck. 3, 4, so calculate out gross margins. Get gross stuff going. Start to actually be really analytical about that value and that value creation, and what is the difference between the machine and what are the ingredients producing your product. Right, align your actual results as well too. 6, get all your assumptions, all those things, the lifetime values, the CACs, etc., to be clear so that you can create 7 scenarios. Remember, create high case, low case, and probably an emergency plan as well too. Get serious about cash flow. Build 3-way accounts. If you've started to accrue, like we talked about, then you're going to have cash flow timing differences. You want to actually start to get those going as well too. All right, fine. Do it with skill, care and diligence so that you can demonstrate that actually you're going to be responsible with the capital. And 10, go out, seek help. There's some fantastic mentors out there. There are great virtual CFOs. There are great people that are interested in helping you do this. So go out, get the support, bring it in-house, get trained up. I'm still learning all about this stuff as well too, after decades of doing this. So yeah, go out and get help. So I'm going to leave you with one final bit and take a couple of questions with a few minutes to go. Finally, if you win an investment and you've got it, keep it up to date. Keep doing this monthly, report it back to management, report it back to your investors at least quarterly, but even better, do it monthly. Awesome. Okay. Now, we've got some questions coming through here. I'll put it. So here's a good one. Do you recommend top-down or bottom-up forecasting? So this is a really interesting topic because we have, basically, in essence, I recommend doing both. But my preference is for bottom-up. And it starts because we want to look at those actual results, which I was talking about. You want to start with the actual results and see that you can actually do that. Build up from where you physically are, because you need to going to make those sales. If you're going to take a percentage of a market, you actually need people, you need salespeople, you need processes to be able to do that, and that needs to be built up. But it's a really good question. If you don't understand the difference between top down and bottom up is saying, oh, if I hire an extra person, they could make this many sales and grow that way. Top down is saying, if I could take 1% of the market, I would have this much sales. Right? So I think you should do it bottom up, and I think that'll be easy for investors to understand, but you should have an eye and a sense check that you can do it. If you show a bottom up that shows that you're suddenly going to take 85% of the market within 6 months, you know that it's not actually real. So you need to actually do both. Next question. Does a model need to be monthly or quarterly? I think you should, at a minimum, do it monthly, basically. If you're monitoring your business, you need to do it monthly. You need to be doing that, at least looking at it and checking in. Quarterly is just too spasmodic. If you want to, and you don't want the complication, do it quarterly for years out, sort of 4, 5, and 6, then quarterly is fine. All right. Here we go. Another question. So is a good one. Is a revenue, profit, and cash flow break even really not that important? And I guess I was being a little bit cute here to make a point about that, but they may be important to certain investors, but they don't define how you should do they don't define necessarily the value. So some investors may put value on that. You may put value on that, right? If you can reach cash flow break even and you don't need to take more capital into your own your business, that may be valuable to you. However, they don't in themselves define the value. So that's my point. They are important things to understand, but they aren't the primary driver of why you're producing that model. All right, we've got one final question in the last minute. All right, how do you balance, so this is a good one, how do you balance being transparent with investors who use this to talk to you to get your business for a bargain? Right, so I think that the first thing about that question is you've got to, if you're already in antagonism with your investor, that you feel like they're getting it for a bargain and that there is an exchange here that's not to mutually benefit you, then you're already not in a good position with your investor, basically. I would say try and be comfortable with your investor and find an investor where you feel they've got value. Now, the other thing to say, if you're really early stage and there's numbers out there that you can do, so look it up, but it's going to be vitally important for the investor. The price that you get, particularly early on, is going to be much more important for the investor's return than it's going to be for your return as you model it out. So the investor has every interest in you being successful as well. So I think actually, if you're not being totally open with your investors at the early stage, then basically I'm not sure that's a good relationship and you need to do it. So thanks very much. All the best. Bye.